Good evening and welcome. It's good to have you join us on another edition of the program, Capital Market, live on Channels Television. I'm Ladi Williams. Let's begin with a review of some of the equities markets outside our show here. We start first with the world's biggest economy, the United States, which closed Friday's trading session negative across board as investors remain cautious for a resurgence of a COVID-19 virus. Upcoming two-day meeting of the Federal Reserve and a historical tendency for September to be a weak month for the equities. The Dow Jones Industrial Average fell by about 0.5%, while the S&P 500 and the Nasdaq Composite both went down by 0.9%. Over to the European equities market, also closed lower Friday as global investors continue to weigh the prospect of slowing economic growth. Data on Friday showed that UK retail sales fell unexpectedly by 0.9% month-on-month in August. The UK's FTSE 100 index dropped 0.91%. German DAX was down 1.03%, while France's CAC index dipped by 0.79%. And across Asia-Pacific, the markets ended Friday's session earlier in the green, with the Hong Kong index recovering partially from heavy losses earlier in the week. Japan's Nikkei 225 climbed 0.58%. Mainland Chinese stocks closed higher, with the Shanghai Composite up 0.19%, while Hong Kong's benchmark Hang Seng Index closed 1.03% high on Friday. Now let's take a look at some of the events that happened right here in our zone here. The Lagos State government signed a 25 billion naira green bond market agreement with FMDQ Group and financial sector, deepening Africa to develop key infrastructure and social projects in the state. Signing, the governor of Lagos State, Babajide Sanwo-Olu, and the chief executive officer of the FMDQ Group were among those in attendance. Do take a listen.
Climate change is affecting all of us. It is expected to hit developing countries the hardest, especially low-lying states like ourselves. You know, we keep saying that Lagos is below the sea level. It's real, and so we need to do something about it. So climate change is here. However, despite its possible devastating effects being increasingly viewed as a gateway to new business opportunity, opening many profitable ways for investors is to help to protect the planet. One such way that we see that this can happen is through the green bonds.
Today's ceremony represents a significant step towards the actualization of our sustainable development desires and even the enactment of the FC4SL declaration. Indeed, the infrastructure gap poses a huge opportunity for green financing via debt capital markets. The McKinsey Global Institute estimates that $3.3 trillion must be spent annually through 2030 to address the infrastructure gap, which is critical to achieving the Sustainable Development Goals.
All right, moving on now, let's look at what's happening with some dividend payments. Over 700 billion naira has been paid out as dividend to investors by companies listed on Nigerian Exchange Limited so far this year. According to a statement released by the NGX, 58 firms across 10 sectors, quoted companies on the exchange, have paid out 732.91 billion naira, with Dangote Cement as top among these 5 listed companies who made the highest dividend payments, followed by MTN Nigeria, GTCO, Boa Cement, and Stanbic IBTC. Across the sectors, the financial sector has the highest number of companies paying dividends, and value led by GTCO. Nestle led the consumer goods sector, Fitson, the healthcare sector, and Total Nigeria takes the lead in oil and gas sector. UACN led the conglomerates. MTN Nigeria tops the ICT sector. Caviton tops services sectors. Komu led the agriculture, of Dangote Cement is number 1 on the industrial good sector of the NGX. And Central Bank's Monetary Policy Committee has maintained its key lending rate at 11.5% with the asymmetric corridor of plus 100 and minus 700 basis points around the MPR. At the end of its 2-day bi-monthly meeting on Friday, MPC also retained the cash reserve ratio at 27.5% and liquidity ratio at 30%, in line with analysts' expectation. Meanwhile, CBN Governor Godwin Emefiele says the financial markets regulator is determined to eliminate the activities of illegal forex traders. And let's cross over now to the fixed income market, where trading in the Treasury bond secondary market was also bearish following sell-offs in the early parts of the week from local and offshore investors amid the uncertainty on the direction of yields short. The average yield expanded at the mid and long segments as investors sold off the March 2027 and April 2049 bonds, while it declined at the short end following demand for April 2023 bond. At the Treasury bills market, bearish sentiments persisted following 2 consecutive weeks of NTB auctions. This week's NTB primary market auctions, the CBN offered and eventually allotted bills worth 155.88 billion naira. Meanwhile, for the open market operation, bills were up by 2% week on week to close at 6.34%, while CBN special bills dipped 9.47%. Meanwhile, the domestic stock market ended the 3rd week of September mildly positive, with about 11 billion naira gained added to the market's overall value amid a weak investor interest for equities. The benchmark indicator of market performance closed the week up by 0.06%, following a mild rebound recorded on Friday. Our negative sentiments swept across the 5 key sectors of listed equities. However, performance on the activity chart of equities market was negative when compared to last week's trading, as total volume and value of shares traded fell by 39.95% and 17.76% each. Meanwhile, UPDC led the pack of 20 gainers, up by 11.8%. SCAR topped a long list of 38 losers with 18.46% drop in its share price, while the trio of Axis Bank, Universal Insurance, and WEMBank were the major contributors to the total number of shares traded this week. And now to discuss what happened in the week, review the market performance, let's talk to our guest now, stockbroker and former registrar of the Chartered Institute of Stockbrokers, Mr. Adedeji Ajadi. Great to have you on the program. Thank you for joining me.
Thank you for having me.
All right, so since, look at the MPC meeting now, since the last meeting in July, you know, the all-share index has recorded a meager gain of about 0.3%. So, you know, what do you expect from this meeting that happened just yesterday?
Well, of course, just like it was mentioned, a lot of the statistics were retained, the MPR 11.5. One of the reasons why the equities market has been like this, choppy, not really very vibrant, has been because of the rates in the fixed income market, driven by the MPR. Once the rates in the fixed income market is a little bit attractive, you see a lot of investors moving to that particular segment of the market. Apart from that, valuations in the equities markets will then be weak because the cost of capital would then be quite high. So those are the factors not helping the equities market, among other challenges. Of course, don't forget about the FX issue now.
Exactly.
Foreign investors are not really going to come into that market at this point in time when they know that there's a whole lot of uncertainty. How do they exit the market if they invest now? They are not too sure whether they will be able to get FX and at what rate that they are going to get it. So these uncertainties in the macroeconomy is a major issue for the equities market.
But looking at the meeting now, you know, post-meeting reactions, you think it's been priced in already in the equities market?
Everything is still the same. Actually, more or less, we are just continuing. The good thing about what the CBN is doing is some level of stability. Because that is also very, very key. There must be some degree of stability for the market to thrive. But when you take the overall macroeconomic environment into consideration, the equity market does not have the trigger to really be vibrant the way we want it to be. No catalyst right now.
Well, but looking at the Fugas, I see their stocks gained about 12.78 billion naira during the week. What can we attribute to this movement right now?
Well, that is the strength of the capital market.
Right.
You know, a lot of when you talk about performance, your focus is largely always going to be the financial services sector. The companies there have done quite well over the years. They've been very consistent. They pay dividend consistently. So the first place you think about if you want to invest is the financial services sector. So on a continual basis, likely that you will see a lot of interest in that particular segment of the market.
Now,
so
how can we see other sectors getting this kind of attention at some point?
It's about performance. It's about performance and consistency. Of course, what an investor wants is to put in your money and you are sure you are able to get some commensurate return at the end of the day. So if other sectors move up and continue to be consistent and do well, investors will take interest in them and buy more into those sectors.
Okay, but for you now, what stocks would you say stood out? Considering the market has been choppy, but some stocks have actually given gains of about 300%. Take, for instance, Morrison. What kind of stocks should we be looking at this point?
Oh, well, why I won't mention specific stocks.
Right.
That's the job of investment advisors. But the truth is that the market always has opportunities. It's about the intrinsic value of stock. Especially when you have challenges like this, market being choppy, market not being very vibrant, you see a lot of stocks that are really, really undervalued.
Right.
They have more values when you consider their fundamentals than what the market is saying. So it is for savvy investors to be able to identify those stocks. They are there. Identify those stocks, position themselves in them and wait until things improve, and then you see the gains coming.
The fear in the market.
Look beyond the fear in the market right now.
Well, despite broadly decent earnings, delivered from by companies in the first half of 2021, they've been spectacular earnings, but it's not really had any impact on investor sentiment in the market. Well, why do you think that's happening?
Investor sentiment is driven by the environment, the macroeconomic environment. So let's ask ourselves a couple of questions.
Right.
Look at the Nigerian macroeconomic environment. What do you see? Rumors, insurgencies, and kidnappings. It's getting a little bit better, but under that kind of an environment of uncertainty, of fear, of risk, people don't go. Earlier in the year, people were being kidnapped and killed on their farms. Right. People are not going to do business. Don't also forget we are coming out from a near recession situation driven by this virus. So the environment is not very, very vibrant and attractive as at this time. A lot of uncertainty. The Delta is coming back, and you read from the US and other European market, they've started reacting to the possibility that the Delta variants might actually become more virulent. So all of these situations are negative for investors. So,
no matter how shiny.
No matter how shiny. So people that overshadows the individual performance of companies that are doing well. So people want to be sure that things are a little bit more stable before they take their money into the market.
No, because I know one very popular investor said you buy when the market is fearful and sell when the market is excited. Is this the time to be buying? Absolutely.
The only thing is that, just like you mentioned, fear drives the majority of people away from the market. It's only the few people who can manage their behavioral tendencies, who can take that risk and come into the market when there is a lot of risk, that eventually now make the gains. The crowd, the herd is going to run away when there is fear in the market. That's what we are seeing.
Right.
So, but for savvy investors, for people who understand how the market works, this is the time to position themselves in some good stocks. I remember last year I was talking to them earlier at the beginning of the pandemic. I was talking to some young people who are intending investors. I said, you have great opportunities. Zenith was selling at about 12 or 13 naira at some point last year. GT was at 16 naira at some point. So I told them, this is the time to put in your money in the market when everybody is running away and afraid. A couple of them put in there, and I tell you, by the end of the year, 100% returns. So that's the situation, but not everybody knows that.
Not everybody knows that. Okay, well, looking at the fourth quarter now, what do you think the market will be looking like in that point?
I hope things improve. I hope the macroeconomy improves, especially if we get a better handle on the Delta variant, and the fears does not go across the global market.
Right.
And then locally in Nigeria, we need to ensure our macroeconomy is a lot more stable. Let's deal with this FX uncertainty.
Oh, yes.
If you can be sure of that, and there's a lot more security, people are confident about the economy, you see the capital market growing. So a whole lot of these are factors driven by the overall environment. So government has a whole lot of role to play in ensuring an environment that is stable, an environment that is attractive for investment. If we don't have that, you will likely not see any major changes. I hope those changes will come.
Oh, yes. The market needs a catalyst, and this is the time for it. All right, Mr. Ajadi, we'll take a break now. We'll come back with discussing what's happening in the Eurobond market. That's in a moment. Do stay with us. This is Capital Markets. Welcome back. You're still watching Capital Market live on Channels Television. Before we go into our next discussion on Eurobond market, let's bring you some related happenings in that space. Let's start off with Axis Bank. Now, Axis Bank PLC announced the successful launching of a $500 million Eurobond. It's part of its global medium-term note program. Statement sent to the Nigerian Exchange Limited. The Tier 1 financial institution said the 5-year unsecured note was oversubscribed by more than 3 times, $1.6 billion on its order book, the largest order book ever for a Nigerian bank Eurobond transaction. This comes as it recorded massive interest from top quality investors globally, including United States, Europe, Middle East, Asia, and Africa. The bond, which will mature on September the 21st, 2026, was issued with a yield and coupon of 6.12% with interest payable semi-annually in arrears. And meanwhile, the federal government has begun a 2-day meeting with potential investors over an issuance of a $3 billion Eurobond issued through the international capital market. The 2-day virtual meeting, which began on Friday, will continue September the 20th. Meanwhile, the Debt Management Office says proceeds from the Eurobond sale will be used to finance various projects in the 2021 Appropriation Act. And now we'll continue this conversation with Mr. Ajadi to tell us how this Eurobond is moving right now. Well, it's been a bond week. We've had the federal government announce plans for the Eurobond to raise about $3 billion and not more than $6.2 billion. What do you think, is this the right time, for this, considering, our current debt stock right now?
It is a concerning situation. I mean, it gives a lot of anxiety when you know what is happening in the economy as a whole. But I think we don't have a choice at this time. Without debt, we won't be able to fully finance our 2021 budget. That has been in the budget from the very beginning.
Right.
So the question we need to ask ourselves is, what are the benefits and advantages? And I think there are some advantages with the Eurobond. First one is that they are denominated in foreign currencies, especially at this time when we are grappling with the issue of FX inflows. So that can handle that a little bit of those challenges. At least we can have our foreign reserve a little bit improved upon based on that. And also it allows domestic firms to be able to access the local market without the federal government crowding them out, because of the strength of the federal government. If they go into that market, they can actually crowd out the opportunities for domestic organizations to raise funds. Those are benefits. The worry we need to think about are, one, we are getting back to the territory where our debt situation is getting unsustainable. The amount of money we are using to pay just interest on debt now is getting alarming. And I think this is the right time to start thinking about what to do. It's a big issue. We need to address it as a nation. We don't want to get to the situation we were before the Paris Club debt forgiveness. So I think that's one thing. The second most important thing is really, how do we make use of these funds? Because the way it is now, nobody has given us, it's just a very general bond. It can be used for anything.
Right.
I mean, unfortunately, we don't have a very good record in terms of management of resources. So people will be worried.
This is actually the 7th, Eurobond. Last one was in 2018. The country raised about $2.86 billion. And
so people the question is, so are we seeing the effect? The ones we've raised before, what exactly can we say we did with those funds? The election year is coming here, and people have started saying, "Oh, this is going to go into election." I mean, I'm not saying that it is, but the point is, how utilization of this fund, we want to be sure that this is going to be used for the benefit of the economy. I think there are better ways to structure debt in such a way that it is targeted towards specific projects which we can see, which we can monitor, just like to cook, for instance. You can see what it is, it will be listed, what it's going to be used for. This general one that can just float in the air, you just disappear, you don't know where it is, that is a big worry for analysts.
And this is the first time, you know, local investors are actually going to be taking on this roadshow. How do you expect local investors to actually react to this bond?
I believe that those who have the fund will want to take advantage of it because this Eurobond is also, the pricing is good. I mean, generally you don't have that level of returns on Eurobond, so it's attractive. But the question one would also ask is that with the kind of shortage of foreign exchange that we have in Nigeria. So how many people have the foreign exchange, foreign currencies to be able to invest in those funds? So there must be some very few Nigerians who are in that position to be able to have access to foreign exchange to invest in the Eurobond. Majority of Nigeria definitely are not in that category.
And most local investors will be looking to actually protect, you know, their portfolios at this time. So this is a good
it's a good opportunity. If they have the funds to be able to invest locally.
So you actually need foreign currency to invest.
Foreign currencies to invest. So how do you access the foreign currency?
Right. So let's look at Access Bank now. They had a $500 million, successful unsecured Eurobond. It was oversubscribed. What was so attractive about this one?
Oh, you know, that's an investment. It's more or less like you are giving loans to Access Bank. That's what it means. Right. When Access Bank goes to the market to raise funds, the only thing that it is in foreign currency. Access Bank is one of our very strong, reliable banks that have done well consistently over the years. So is attractive, and that's why you saw a lot of interest from not just.
I also had a successful one.
So our banks are organizations to be proud of. Quite a number of them are doing very well. They can compete with some of the best anywhere in the world. So they are attractive
so we
investment opportunities.
More, you know.
I'm sure more banks will take advantage of that, especially now where we have this challenging situation with foreign exchange.
Okay. Well, you know, looking forward, what's your outlook for this Eurobond market right now in Nigeria?
Well, I think this one will succeed. I think people will invest in it, but maybe a lot more from the foreign investors, much more than the local investors.
Much more than the local investors.
That's what because I mean, I don't see a lot of people having that access. You know?
Well, it's new days now, and the year is coming to an end. So how would you advise, you know, investors that are looking for where to put their money right now, you know, considering, you know, the headwinds right now of foreign exchange and all of that?
General advice to investors will be that the capital market is always a market that will yield you returns over the long term. Short-term situations will always make the market unattractive sometimes. Look at last year. Nigeria ended as one of the best capital markets in the world. Exactly. On Bloomberg. 50% returns for the market as a whole. So the market will always reward you if you have that long-term perspective. So always, for me, for those who are in that particular situation where they have a fairly longer term horizon, they should be in the market. There's a popular saying in investment that it is better for you to take time, stay in the market over time rather than you trying to time the market.
Time the market.
It's because it's difficult to time the market. Academic research, the best investors over there, they find it difficult to time the market. That is to know when the market will go up or when it will go. It's difficult for you to know when to come in. So it's rather better for you to stay in the market for a reasonable long period of time. 2-3 years, those returns will come. It's almost guaranteed.
Entry and exit.
An exit strategy.
All right, Mr. Dividend, former registrar, stockbroker the China Institute of Stockbrokers. Thank you so much for coming on the program today. It was great having you.
Thank you. Thank you.
All right, let's take a look at the outlook for next week. We'll bring you some tips of what to do, what to expect from the market and coming. Analysts expect the outcome of the upcoming bond auction by the Debt Management Office to shape sentiments and the direction of yields at the fixed income market. At the auction, the DMO will be offering instruments worth around 150 billion through reopenings of the FGN February 2028, FGN March 2036, and FGN March 2050 bonds. At the same time, average yields on T-bills are expected to trend higher in the coming week, considering the expected strain on system liquidity and the prevailing bearish sentiment in the fixed income market. With the equities market, analysts expect the lull in the local bourse to persist until positive triggers in the form of lower fixed income yields and improved dollar liquidity will spur buying interest from domestic and FPI investors. They also expect risk-averse investors to recalibrate their portfolio towards fundamentally sound stocks with attractive dividend yields in the week ahead. And that's Capital Markets for this weekend. Thank you so much for watching. I'm Ladi Williams. Bye for now.